Welcome back to Wired Wanderer. I'm Mira. I'm still here at home in the United States, and that matters for today's topic. Because this isn't just a story about oil-producing countries. It's a story about why the US dollar sits at the center of global finance, and what that means for America's economy and policy choices. People call it the petrodollar system, and a lot of people misunderstand it. So let's take it apart carefully. The petrodollar system makes the most sense when you remember what happened in the early 1970s. In 1971, the US ended the dollar's convertibility into gold, what people call the Nixon shock. That accelerated the end of the Bretton Woods monetary system, and the world shifted toward floating exchange rates. Then came the 1973-74 oil shock. An embargo and production cuts disrupted supply, and oil prices surged. This was not just an energy crisis. It was also a global payments and finance shock. Oil exporters earned huge dollar revenues. Oil importers suddenly needed far more dollars to pay for the same energy. So the question became, where do those oil export dollars go next? In the mid-1970s, US-Saudi cooperation expanded, including a Saudi trust account at the US Treasury used to fund projects under a joint commission framework. And globally, banks helped channel oil export surpluses back into the world economy, recycling petrodollars through trade and finance. Here's the simplest way to think about it. If a country imports oil, and oil is priced in dollars, that country needs access to dollars. That doesn't always mean stuffing dollars into a vault. Most of the time it means dollar bank deposits, dollar credit lines, dollar hedging instruments, and in some cases, central bank reserves. Now, zoom out. Oil is one of the most strategically important traded commodities in the world. So dollar pricing doesn't just affect oil companies. It affects banks, central banks, and national balance sheets. And here's the key point for Americans. Global demand for dollars doesn't just come from oil, but oil helps reinforce dollar usage because energy is everywhere in the economy. Three actors come up again and again in the petrodollar story. First is OPEC, a producer group that influences supply and therefore global oil prices. OPEC doesn't control the dollar, but it can influence the size of oil revenues that flow through the system. Second is Saudi Arabia, often the most influential producer in OPEC because of its role in managing spare capacity and maintaining production flexibility. Third is the United States, not because the US can command every oil trade, but because US financial markets, US legal institutions, and US security relationships helped make the dollar the default currency for global trade and finance. This is where economics and geopolitics meet. Now let's talk about the plumbing, how dollars actually move. Petrodollar recycling happens through two broad channels. The IMF describes an absorption channel, spending on goods and services, and a financial channel, investing in foreign assets. One major financial pathway historically was offshore dollar banking, often called the Eurodollar market. The BIS gives a classic 1970s style example. A Middle East central bank deposits dollars in a London bank, which then lends them onward to an oil importer. Then there are the payment rails. Cross-border banking often relies on correspondent networks. BIS analysis explains the payment system role of correspondent banking and the centrality of messaging networks like SWIFT in that ecosystem. And at the end of many dollar transactions are US dollar settlement systems like Fedwire, which provides finality in central bank money, and private systems like CHIPS. Finally, there are US Treasuries, the world's benchmark safe asset. When global institutions want safety and liquid collateral, treasuries are often the first stop. If the petrodollar system was collapsing, you'd expect to see the dollar losing ground rapidly. But the data show something slower. In the Federal Reserve's globally disclosed reserve data, the dollar's share was about 71% in 1999 and 57.8% in 2024. That's a decline, but it's not a collapse. And the IMF's newer methodology, where they impute previously unallocated reserves, shows the dollar at 56.92% in 2025 Q3, with the IMF cautioning that the methodology changed starting 2025 Q3. So the direction is gradual diversification, not a sudden switch. Now, people often say, oil exporters buy US Treasuries, and that funds America. That's partly true, but it needs nuance. Foreign ownership of marketable US Treasuries has changed a lot over time. In Federal Reserve data, the foreign share peaked around 56.5% in 2008 and is about 31.7% in 2025. That means the US has relied more on domestic buyers and the Federal Reserve at different times, especially after crisis-era expansions of the Fed's balance sheet. Still, in absolute terms, foreign holdings remain enormous. The Treasury's TIC reporting shows total foreign holdings around $9.27 trillion December 2025, with Japan the largest reported holder at about $1.19 trillion. A key caveat: TIC country labels reflect custodial reporting locations and may not perfectly identify the ultimate owner. So what does this mean for the US economy? The dollar's global role gives Americans real benefits, but also risks. Benefits first. It can mean structural demand for dollar assets, including treasuries, which can support lower borrowing costs than the US might face otherwise, especially in crisis periods when safe asset demand spikes. It also means America can run persistent trade deficits more easily than many countries, because global finance treats US markets as the core parking place for savings. But there's no free lunch. Reserve currency status can also encourage complacency, bigger deficits, more debt, and political fights that threaten the credibility that makes the whole system work. So the petrodollar system doesn't guarantee prosperity. It amplifies the advantages of credibility and amplifies the costs when credibility weakens. There's also a geopolitical layer. When global payments run through dollar rails, it raises the power of US sanctions. Because access to correspondent banking and messaging infrastructure matters, the BIS describes how correspondent banking is crucial for cross-border payments and how SWIFT messaging is deeply embedded in the ecosystem. That doesn't mean oil is the only reason sanctions work, but oil trade is one of the biggest arenas where payments and geopolitics collide. And in moments of crisis, like major oil disruptions, countries with strategic reserves coordinate through institutions like the IEA, showing how energy security and macroeconomics remain linked. Now, the petrodollar system has critics. Some critiques are economic. They argue dollar pricing creates dependency, especially for countries that must constantly manage dollar liquidity. Other critiques are political. They argue the system encourages militarized foreign policy, or that the U.S. protects the system through force. This petrodollar war idea exists in public debate, but it's difficult to prove in a clean causal way because wars, alliances, and energy policy have many overlapping drivers. There's also a modern critique connected to climate politics. If global finance stays dollar-centered partly through fossil fuel markets, some argue it slows the transition to a different energy system, or politicizes investment debates through ESG. A careful way to say it is this: the petrodollar system reflects path dependence. Once a currency becomes the default for a huge global market, switching costs are real, even when politics or technology change. Since 2014, three changes keep coming up. First, U.S. shale and energy changes. The U.S. became far less dependent on imported oil than it once was. The BIS notes that fewer U.S. oil imports could mean fewer petrodollars flowing into the global financial system, potentially affecting liquidity and currency choices at the margin. Second, China's push for RMB energy pricing tools. In 2018, China launched RMB-priced crude oil futures on the Shanghai International Energy Exchange. Third, sanctions-driven settlement shifts. Reuters has reported that China dramatically increased the use of yuan to buy Russian commodities, with much of that trade settled in yuan instead of dollars. Now add a fourth change: technology. Central banks are experimenting with CBDC infrastructure for cross-border settlement. BIS Innovation Hub work like Project mBridge reached a minimum viable product stage in mid-2024. And in U.S. markets, financial innovation has also tended to reinforce dollar-centered products. The Federal Reserve notes the dollar plays an outsized role as an anchor for stablecoins. And U.S. regulators approved spot Bitcoin exchange-traded products in 2024, meaning even alternative assets often arrive through U.S. dollar-based market structures. The big picture is not a single trend. It's a tug of war. Market liquidity and safety reinforce the dollar. Geopolitics and technology create alternative pathways. So what happens next? There are three broad scenarios people talk about, and it's helpful to think in probabilities and timelines, not absolutes. Let's lay them out. Before we end, I want to be explicit about what we know and what we don't. First, there is no comprehensive public data set that cleanly measures the global percentage of oil invoiced in dollars across all contracts and routes. The IMF notes invoicing currency data aren't readily available in standard data sets, and broader reporting standards will take time to develop. Second, holdings data have attribution issues. TIC data show reported holders, but custodial locations can blur true ownership. Third, correlation is not causation. Petrodollar flows can reinforce dollar demand, but the dollar's global role also comes from many other forces: market depth, rule of law, and the scale of U.S. finance. So the responsible conclusion is not oil alone guarantees dollar dominance. The conclusion is oil is one important piece inside a much larger dollar system. If you live in the United States, here are the practical implications to watch. The petrodollar system is strongest when the world trusts U.S. institutions and U.S. markets. So the most pro-dollar policies are not slogans. They are fundamentals. Keep inflation contained. Keep treasury markets liquid and predictable. Protect the rule of law and property rights. Second, energy policy still matters for monetary stability. Oil shocks still show up in inflation and household budgets, and strategic reserves are still part of crisis management. Third, sanctions are powerful, but they're not free. Overuse can speed the search for alternatives, even if the transition is slow. And fourth, technology is not automatically anti-dollar. Stablecoins and U.S.-listed financial products can extend dollar usage into new rails, if regulation and market design keep them safe. That's the petrodollar story, viewed from America, as an economic system, not a conspiracy. If there's a market system, country, or company you want me to break down next, leave a comment. If you'd like to learn more about this topic, I've added several links in the video description with additional information and sources. This is Mira from Wired Wanderer. Thanks for being here.